when the returns are right at the average, that's actually what's abnormal. 90% of the time, the market ends up finishing something that's quite different than what the average is, and
So,
what you end up building.
So sell when we're at the average.
There you go. Something like that. But it's just
No.
I want people to realize that if your annual returns are not exactly what you expect your average to be, it doesn't mean something's broken. That's just the price of admission.
Hey, welcome to the fourth quarter Strong Valley Roundtable. We've made it through 2022. It's been quite an interesting year, but just wanted to start off on where the markets are at, and Kyle, you want to do a little market recap for us?
Yeah, I'm going to go ahead and pull up a slide here. There's no way to sugarcoat it. This year's been really a rough year for us. So I know we highlighted a little bit in our last roundtable, but it's been tough for all clients this year, even our more conservative accounts too, because as you can see here from the slide, worst year ever for the bond market. So the U.S. Ag is down roughly 14.5% through September, which was the last quarter. And fourth worst year for stocks, down around 24%. So kind of when you compound that, doesn't really matter if you're a 50-50 portfolio or a 80-20. It's been a tough year for just about everybody. And in fact, kind of when referencing the 60-40 portfolios, that's normally one that we kind of benchmark our clients reference. And the second slide there shows that it's the second worst year ever for a 60-40 mix in the history. And that worst year goes all the way back to 1931. So, hopefully the results will start to turn here, and we'll see kind of like we have historically over the next 12 months and see a pretty good rally on that. And we'll see how that transpires. But yep, definitely a bad year for people to experience with both the bonds and stocks this year. So, and I'll kind of just highlight it with one last slide here. Only the third time in the history of the market that we've had essentially for a full calendar year, both the stocks and bonds down at the same time. And so kind of looking back at 1931, 1969, there's probably not a lot of us here that remember 1931, but 2022 is on pace to kind of be the third time ever. So just no way to sugarcoat it. It's been a rough year this year.
Yeah. So raw data year to date, S&P down 1585, the Ag's down a little bit over 14. EFA, the international index, is down 1582, and the Nasdaq's down almost 28. Most of your tech stocks. So, like Kyle said, not a great year.
I'm gonna talk for a moment for you guys. I want the folks to see, when we see returns like these, and we see a variance of returns. I've got a chart that'll kind of piggyback some of the stuff you mentioned with what the S&P 500 has done for nearly the last century. And the reason why I bring this up, there's a lot of data on here, but for those listening, the point of this, the point why we mention these returns and mention what some expectations ought to be, so many investors over the years, we've all heard that old adage that if you just kind of leave your money alone, if you leave your investments alone, you leave your balanced account alone, it's not uncommon to average a rate of return of somewhere between 7 and 9%, 7 and 8%, something like that. We've heard that, and that's true. Depending upon which rolling 10-year period of time you're looking at, that average holds up. But the difference there between an average and an annual could not be more different. And I think the average investor then assumes that their rate of returns ought to be somewhere between 7 and 8%. And if not, then something must be broken. And they ought to be changing strategy. They ought to be tweaking. They ought to be doing something. And so, when I polled clients to kind of get what they think has happened over the last 100 years, I frame it like this. Of all the sequence of returns that we've seen, and the way the calendar ends up each year, if you had to guess how many times out of the last almost 100 years, the market has finished anywhere between 5 and 10, so you got kind of a 2.5% cushion on each side of the quote average. How many times out of the last 100 years, plus or minus, has that actually happened? And quite often I'll hear clients say, I don't know, half, half the time does it bounce around the average. And then maybe a quarter of the time it's higher, a quarter of the time it's lower. That's what the average investor expects to happen. And when I tell them the actual numbers, that out of the last, since 1928, only 8 times has the market been finished the year anywhere between 5 and 10. The rest of the time it's way above it, a little bit below it, and sometimes a lot below it. But the variance of returns is pretty dramatic. And so I think I think that's just wise to take from this as we go through another year like this, especially for the clients, is that when the returns are right at the average, that's actually what's abnormal. 90% of the time, the market ends up finishing something that's quite different than what the average is, and what you end up building.
So sell when we're at the average.
There you go. Something like that. But it's just I want people to realize that if your annual returns are not exactly what you expect your average to be, it doesn't mean something's broken. That's just the price of admission.
Yeah, it's really,
and you've hinted at that before, Jason, with our financial planning, is that, we account for these bad years when we're planning and know that, there's a lot of good years ahead too. And so that's why their average is not exact on in a given year.
That's exactly right. Our software, the financial planning software, and any good financial planning software, and ours is completely accounts and expects for the volatility of returns and the variance of returns. It's just the software doesn't know what the headline's going to be, but we know that it happens so frequently. I was telling a client, in the 20 or so years I've been doing this, the market has been down this much or more half a dozen times. So that's about every 3 years that we have the joy of going through something like this. So it is common, unfortunately.
Yeah, for sure. It's hard for people to get their heads around that the abstract concept. They expect everything to be linear, and even our investors, they know it's not going to be directly linear, but then they expect the variance to be really small, kind of like you're illustrating that. Oh, well, if it's if I'm thinking 7.5, then it's probably within 5 and 10. And it just, again, it doesn't work like that. And that's why investing is, it pays to invest, obviously over a period of time, but it's difficult because there's a lot of emotion attached to it.
Right.
I think what's a little bit different this time around too is it really is close to a calendar year or the way we measure in calendar years for where this particular sequence happened to. Because oftentimes this will be a July to February thing, and so you get the calendar year numbers that are within reason, but this seems to be early in the year. Now we're 6 weeks out from the end of the year, and it seems like we've had most of the action in this calendar year, so that's why that number I think is going to be a little bit different this year too.
Yeah, you're right, especially when the way we measure them, right? Because if the top of the market was in September, October of last year, from where you're measuring from point to point, it might be as steep, but the way we look at performance as humans, it always starts on Jan 1.
Yep.
Mm-hmm.
Yeah, unfortunately, economies and markets don't always work on January 1st, but this year we've kind of got it all. So this is another thing to talk about. This has been one of those years where very few asset classes have worked. I want to say it's like 98% of asset classes are down this year, very much like 2008. But one of the things that has worked is the U.S. dollar. Again, not that many people are investing in the U.S. dollar, but just to kind of show historically where the dollar has been relative to other currencies. If we could pop that up here. So there's this, again, this is just an index that tracks the dollar versus a basket of other currencies throughout the world. And you can see the dollar has been appreciating dramatically since basically COVID. Toward the end of COVID there, dollar's been the safe haven asset class. You got other interest rates around the world are lower and then less credit quality than the United States. So you got assets flooding in to the dollar and driving the price up. But recently, dollar has just started to turn around, and you got to think that it can only go so high. There's only so many assets that can flood into the dollar before things start to turn around, and we've seen that in the last couple of months. And just something to mention that the dollar is the strength of the dollar is a big headwind on international investing, because there are two components to international investing. You have the actual asset class's performance, but you also have currency performance. So when the dollar is really strong like this, you're going to see international investments struggle a little bit more than usual, even if their asset performance has been good. But when the dollar weakens, that'll be actually a tailwind to international investing. And we've seen a really long period of time where the U.S. has outperformed international over a decade, and maybe starting to get to the point where that might turn around, and a lot of that because of the strength or lack of strength of the dollar.
And the dollar strength goes along with Fed policy in a lot of ways too. So as our interest rates keep going up, international investors, people that are non-U.S. or banks or institutions, that they're going to want to buy treasury bonds, which means they need to buy dollars to buy treasury bonds. And so part of it is all the geopolitical stuff that's going on around the world. the dollar is still the reserve currency, and that looks to continue for quite some time.